everyone. This is Dr. Supreet from Department of Commerce, Delhi School of Economics, University of Delhi. Today we'll be talking about Introduction to Income Tax, where we'll be discussing about few basic concepts with respect to the income tax. So, when we talk about income tax, the major thing that comes into the mind is Income Tax Act 1961. That is the supervising or segment or the act that takes care of all our taxes, all our direct taxes. When we talk about taxes, we have two sort of taxes, that is direct taxes and indirect taxes. Now, when we talk about these two sort of taxes, that is direct taxes and indirect taxes, we do talk about the incidence of tax and the impact of taxes. When we talk about direct taxes, the incidence of taxes and the impact of taxes, it lies on to the very same person, as in case of our income tax. In case of income tax, the very initial impact of taxes and the ultimate incidence, that is the person who will be paying of the taxes, will be the one, that is we citizens of India. Right. So this direct tax is a form of our progressive tax. That means with every rising level of income, there will be rising tax liability. And the other type of our taxes is our indirect taxes, where when we talk about this incidence and impact of the taxes, it actually lies on two different persons. That means initially the initial incidence of taxes, impact of your, you could say the initial impact of your taxes, it is initially levied on to someone else and they are ultimately borne by the second person. For example, in case of your GST, for example, you are going to purchase a burger from any restaurant. So, therein, the ultimate taxes are though being paid by the consumer, but they are being collected from those restaurant owners. So, that is why here the impact and the incidence of taxes, it lies on two different persons. So, these taxes as compared to our direct taxes are the regressive taxes. That means irrespective of any level of your income, you are supposed to pay the same level of taxes. For example, it doesn't matter whosoever the person is, right? So he'll be paying off the same set of taxes when he'll be buying a burger, whether he belongs to a upper category income or a lower category income. Now, when we talk about these direct taxes, right, so this direct taxes, specifically the Income Tax Act, is the one which takes care of all our income taxes. And when we talk about income tax, there are few concepts that should be kept into mind before moving ahead. So, the very first concept that comes into the picture is your assessment year. Now, the assessment year is the period that starts from the 1st April and that runs throughout 31st March of the year. When we talk about this particular year, starting from 1st of April 2022 and running till 31st March 2023, for this particular financial year, the income will be assessed in the next financial year. That means whatever income you are going to earn in this period of 1st April 2022 to 31st March 2023, that particular income will be assessed in the next assessment year, which in your case will be 1st of April 2023 to 31st March 2024. So it falls immediately on the very next year with respect to your relevant previous year. Now, here I am stating about previous year means the year, the very particular year in which the person has earned the income. For example, a person has earned the income in the financial year, let's say 22-23. That means the presently running previous year. So his income will be assessed in the next assessment year, and then in that scenario, our previous year will be counted up as 1st April 2022 to 31st March 2023, and correspondingly the assessment year will be 1st of April 2023 to 31st March 2024. So herein you could see a financial year plays the double role. For a particular relevant previous year, it will be acting as both the previous year, and for the another set of year, it will be acting as an assessment year. Now, when we talk about this previous year is actually uniform. That means no matter what the assessee is, this previous year will remain the same. That means it will be uniform for all the assessees, right? But in case when we talk about any person who has set up a business or started with any profession, in that case the period of first previous year can be less than 12 months period. For example, if a person has just started a business on, let's say, 1st of March 2023, supposingly he'll be starting up the business on 1st of March 2023. Now in that case, his first previous year would be from 1st March 2023 till 31st March 2023. So here in this case you would be seeing the period is less than 12 months. So in those cases where a new business is set up or a new profession is there, in those cases the period of your first previous year can be less than 12 months. But for every second and any subsequent previous year, the further previous years have always going to be the period of 12 months, that is running from your April till March. It cannot be changed. They have to be uniform for each and every sort of your assessee. For example, let's say any person, Mr. X, he has started a new venture, let's suppose on 14th of May 2022. So in that case, his first previous year will be from 14th May 2022 to 31st March 2023. Now, for this particular person who has just initiated his business on 14th of May 2022, the second and subsequent previous year, as I mentioned right now, that it will be uniform no matter what your first previous year is. So in this scenario, the second and subsequent previous year will be starting from 1st of April 2023 to 31st March 2024, and so on will be there the subsequent previous years. Now, let's suppose any person has started a new venture on 29th of March 2023. So, in that case, the very first previous year for that particular person will be starting from 29th of March 2023 till your 31st of March 2023. And similarly, the second year and the subsequent years are going to be uniform. That is, 1st April to 31st March period will be considered as your, the complete full 12 months period as the second year, previous year period. Now, presently when we are talking about previous year in the assessments year, since we are running into this February, so we are presently in the previous year which started from 1st April 2022 and will be closing on 31st March 2023. So this is going to be our previous year, and this previous year's income is going to get assessed in the assessment year 1st April 2023 to 31st March 2024. Now, when there are certain exceptions also, that means usually the income of the previous year is taxable in the immediately following assessment year, right? But there are certain exceptions wherein that means the income earned in a particular previous year will be assessed in the same year. That means in those scenarios, the previous year is going to be the same as your assessment year. Now, what are all these cases wherein your previous year will be playing a double role, that is the role of a previous year and the role of an assessment year? So, there are 5 cases when we are talking about these exceptional categories. The very first being the income of any non-resident from the shipping business. So, any income of any NR person who is earning it from the shipping business, in those scenarios, his income will be taxable in the very same year. Similarly, when we are talking about a person who is leaving India for a longer period of time or leaving India permanently, so that the taxes are not evaded or we do not lose those tax revenues. That is why the income in certain cases will be taxable in the same particular year. Similarly, any body of individuals which have been formed for a shorter period of time or for a shorter duration, so in those scenarios also your income will be taxable in the same previous year. Similarly, any person where there is a doubt, there is a suspicion that the person is trying to alienate his assets or trying to avoid the taxes, so in those cases also the income will be taxable in the same particular year. Similarly, the last very case being where the income is arising from such a business that is discontinued, that is no more longer there into existence. So in those cases also the income is going to be assessed in the same previous year in which it is earned. Now, when we talk about income tax, there are certain other concepts or the key terminologies that is to be kept into mind before moving ahead. So that is, one is a person. When we talk about this term person in income tax, here by person we means any individual, any company, be it your ABC Limited, any firm, any Hindu undivided family, for example X and so family, right? Any association of person being formed, any body of individuals, let's suppose the XYZ cooperative society, local authority, let's say any municipal corporation for that sake, for example Municipal Corporation of Delhi. So that is what? That is a local authority and we will be classifying it as a person. Similarly, every artificial judicial person, for example any university, for example let's say University of Delhi itself, so that will be classified under the category of your person. So we will be defining all these categories as a person whose income is going to be assessed under the Income Tax Act 1961. Now, when we say the income is going to be assessed, right, so we here means that particular income is going to be computed for whom? For the assessee. And here by the assessee we mean a person who is liable to pay the income tax under the act. And when we say assessee, that means whose income is being assessed. So we too have four categories of people, four categories that would be classified as assessee. The very first being the person, as we discussed in the previous slide, right? So all those category of, let's say, the local authority, artificial judicial person, everybody would be counted up in this very first category. Second is the persons against whom we are saying any proceedings being taken. For example, right now we talked about the first category being the person. In person, when we are talking or referring to them, in those scenarios, whether the proceeding being taken against them or not taken against them, that doesn't matter. We are just classifying them into the very first, the major segmentation of our person. But in this second very category, we are talking about all those persons against those or against whom the proceedings have been taken up under the act. For example, that person is liable to pay off the taxes, or let's say the person is liable to pay off the interest, any penalty, any fee for that sake, right? So that would come under the very second category of your assessee. The third word being is you're deemed to be an assessee. Deemed here we mean by is assumed. That means you are assuming the person, the assessee, as to be in the person who is liable to pay off the taxes. For example, any representative assessee, that means a person who is paying the taxes on behalf of someone else. So he'll be considered, that means he'll be deemed, assumed as an assessee. The last very category under this your key terminology of assessee is your assessee in default. That means a person, let's suppose, who is supposed to deduct the taxes, that means the TDS, that is your tax deducted at source. So supposingly he fails to do so, or let's say after deducting the taxes he fails to submit those taxes to the government. So in that case, that person would be classified as your assessee in default. So these four categories falls under your this major definition of your assessee. Now another concept when we talk about Income Tax Act comes into the picture is your exemption and deduction. So there is a major difference between your exemption and your deduction. For example, if I say that I am holding an agricultural income, or let's say any pension received from a gallantry award, or let's say any educational scholarships being received. So all those income are exempted. That means they will not be included in the computation of your main income. So when they are not included, that means they are totally exempted incomes. No taxes would be charged onto the same. Whereas your deductions, that means it comes from the word deduce. That means your income will be deduced. That means your, let's suppose under chapter 6, certain deductions have been given by the government, and these deductions are specifically, they run from 80C to 80U. So in order to boost the investment in the economy, right, in order to provide certain incentives to the people, government provides these deduction. For example, if we see about section 80C, so section 80C's main intent is to boost the investments and savings. In those scenarios where your investments and savings are they are boosted up, and the government is providing you this leverage that in case you are saving your, let's say, your income, and you are saving it in a public provident fund, in a LIC. So in those cases, what will happen out is it will boost your investments and savings in the economy. Similarly, what will happen is there will be capital formation, and this capital formation will lead to a multiplier impact on the economy. That means your GDP will enhance, your economy will prosper. So any person, let's suppose, in investing into LIC, any national savings certificate, any sort of your PPF, he or she is eligible to claim a deduction under section 80C. So similar to 80C, there are number of other sections. For example, your 80C के बाद अगर हम बात करें, we have 80D, we have 80E, we have 80G, and so on till 80U. So all these deductions are there under your chapter 6. Now, for example, when we talk about these deductions, let me just quote a very simple example. For example, Mr. X, he has earned an annual income of, let's say, 12 lakh rupees from his salaries. Right. Now, out of that 12 lakh income, he saves 1,30,000 in the PPF accounts. So that means if he is making that saving into PPF account, our section 80C, that savings up to 1,50,000 are eligible for deduction under 80C. That means in this case, the person can claim a deduction of this rupees 1,30,000 which he has saved into PPF account, and he is not supposed to pay the taxes onto that entire income of 12 lakh rupees, that is his gross total income. He will get what is, he will get a deduction of 1,30,000 rupees, and after getting that deduction of 1,30,000 rupees, whatever is the remaining income, right, in this case it is your 10,70,000 rupees. So he is supposed to pay the taxes on this net income of 10,70,000 rather than the entire gross total income of your rupees 12 lakh. So what happens out is that due to all these deduction that has been provided by the government, the person is able to save the taxes, and parallelly it is able to boost his or her investments or the savings, right. But there is a upper capping. That means we do have a threshold under section 80C, which means, for example, let's say in this particular case, instead of 1,30,000, I am saving 1,70,000. So government says you can only get the benefit up till your 1,50,000 rupees under the section. So this 1,50,000 is the upper cap. That means it cannot exceed this 1,50,000 ka threshold. No matter whether you are saving 1,70,000, you will be only getting a benefit of your rupees 1,50,000. So in this particular scenario, where I am having a gross total income of, let's say, 12 lakh rupees, right, and I am saving into PPF rupees, let's say, 1,70,000, but I will be getting what? I will be getting a benefit of maximum 1,50,000. So in this case, my net income will be 10,50,000. So always remember, the taxes are always paid on your net income, right. Next, when we talk about income tax actually lies onto 5 main pillars, or we classify them as the 5 major heads of your income. So it is as your salaries, house property, capital gains, profits and gains of business and profession, and other sources. So when we call about salaries, so under salaries, for example, any person is an employed into any government or a private segment, right? So from those sectors he is getting some salary in turn, so that income will be taxable under the head income under head salaries. Second is, let's suppose I am having any rental income. So any rental income that the person is getting from any particular property, that particular rental income will be taxable under the head house property, and so on. There are the incomes which relates to capital gains, which relates to the sale of assets, and PGBP, which relates to your profits or the gains of any businesses and profession, and the remaining heads of income is taxable under the head other sources. So for the day, this is all about the basic concepts of the income tax. So thank you.